Welcome back to the deep dive. This is where we take a stack of source material, sometimes from completely different worlds, and pull out the core insights for you. Look, if you're trying to achieve financial freedom by just, optimizing your budget down to the last penny or trying to memorize all these complex investment rules, today we're going to suggest a pivot. The thing that really jumps out from our sources is this: the secret to building sustainable wealth. It isn't really found in the dollars and cents. It's an internal thing. It's about your mindset.
That's exactly it. That's the core tension we're diving into today. We've synthesized two sources that honestly seem like they come from different universes. On one hand, you have this really foundational personal advice on cultivating a smart money mindset. It's all about the psychology of wealth.
Okay.
But then on the other hand, we're going to take that theory and test it in the hottest fire we can find. We're talking about the high-stakes, super specific world of derivatives trading.
And we're going to break down a pretty complex options strategy, right? The one the source is called the synthetic unicorn. So our mission for you is to bring these two worlds together. We want you to walk away from this understanding that any strategy, whether it's simple budgeting or managing a huge options portfolio, that strategy only gets you halfway.
Right. The other half is the psychological foundation. You have to have it.
So we're going to unpack what a wealthy mindset really is, and then we'll see how it holds up when it's facing the kind of pressure you find in what traders call the options zoo.
All right, let's start with that foundation. For most people, I think financial freedom is a number. It's a goal you hit in your bank account. But our sources really push back on that idea. They argue that it's less about the final figure and more about understanding your personal definition of wealth.
It really is. It's the difference between chasing a score and building a sustainable way of being. When you focus on mindset over money, you're building a foundation.
How so?
Well, it dictates how you interact with everything related to finance. You start to prioritize knowledge, discipline, and this is the big one, a kind of resilience that lets you handle setbacks. But hold on, isn't that just motivational fluff? My budget spreadsheet doesn't care if I have a positive attitude. How does a growth mindset actually change the math?
That is the critical question. And it changes the math because it changes your actions.
Okay.
A positive mindset, it's like the engine for being proactive. It lets you see a challenge, say a market dip or a surprise bill, not as a total catastrophe that makes you panic sell everything.
Boy, which so many people do.
Exactly. But you see it as an opportunity for growth, or maybe a chance to reallocate strategically. That resilience is what gives you the confidence to make better long-term decisions. One of the sources has this quote that just anchors the whole discussion. It's not about the money you make, but the mindset you hold that determines your success.
I like that.
When you really build that mindset, one that values, say, delayed gratification and continuous learning, you build something that lasts. Without it, even if you get a sudden windfall, it's often gone just as quickly.
So, if the mindset is the key, what are the big roadblocks? What are the things that stop people, even people who make a decent living, from actually getting there?
Our sources point to three really deeply ingrained barriers. The first is a scarcity mentality.
Okay, I feel like I see that one everywhere.
It's so common. The second is a fear of failure, and the third is just these deeply held limiting beliefs.
So that's scarcity mentality.
Yeah.
How does that actually play out with your money?
Oh, it's crippling. It just breeds this constant anxiety. You're so focused on the possibility of loss that you literally can't see opportunities for growth, even when they're staring you in the face.
So you're just trying to protect what you have.
Constantly. You see your capital not as a tool you can use, but as this finite resource you have to hoard. And that paralysis means you miss out on the very investments that build wealth.
And I'm guessing the fear of failure just compounds that.
It goes hand in hand. If you're terrified of losing a single dollar, you're never going to put a dollar to work for you. And that just shuts down the whole process.
This is where that big transformative step comes in then. The research says we have to completely reframe how we think about money.
Exactly right. You have to shift from seeing money as this thing to be hoarded.
Yeah.
And start seeing it for what it is. A tool.
A tool?
A tool. It's a mechanism to create opportunities, to invest in your future, to achieve your goals. That's the moment you stop just keeping score and you start seeing the potential. You move from scarcity to a growth-oriented mindset.
And thankfully, the sources don't just leave us with the philosophy. They give us some really practical, actionable steps to make that shift. It starts with your internal monologue, right? First, you have to identify and then actively challenge those limiting beliefs. So instead of thinking, I can never save enough, which, let's be honest, becomes a self-fulfilling prophecy.
It really does.
You replace it with something like, I am capable of building my wealth through consistent strategic action.
And then beyond just what's in your head, they say you need to restructure your environment. Surround yourself with positive influences, people who are financially smart and who, lift you
I've
up.
set clear goals with
Yeah.
timelines.
Yes, realistic timelines.
Yeah.
And finally, and this one's important, practice gratitude for what you already have. That little shift in focus from what you lack to what you have is huge. It moves you from scarcity to abundance.
There's a great example of this in the sources, the story of Sarah. She was a single mom living paycheck to paycheck. And her big breakthrough wasn't some big promotion or winning the lottery.
Oh.
It was a realization. She realized her own scarcity mindset was her biggest problem. She was so worried about running out of money that she just hoarded every extra dollar, which meant she never invested.
Right.
But once she shifted to an abundance mentality, that $1,000 she had saved was no longer her final emergency buffer. It became seed capital.
Ah, such a powerful shift.
And that one little change in perspective allowed her to start taking small, measured steps into investing. And eventually she became a really savvy, long-term investor.
Sarah's story is perfect. It shows that foundational work.
Yeah.
But what happens when you take those principles, discipline, delayed gratification, and you put them under extraordinary financial pressure?
And that's our transition. We're moving from Sarah's kitchen table to the high-stakes world of the derivatives market. We're about to stress test the smart money mindset against instantaneous, life-altering money.
Welcome to the option zoo.
The option zoo, home of all the exotics, right? Iron condors, bull call spreads.
And the specific creature we're looking at today, the synthetic unicorn.
What's so interesting here is that this strategy, the synthetic unicorn, it isn't some complex bet on which way a stock is going to go. It's more like financial mimicry.
That's a great way to put it. The core idea is all about capital efficiency.
Yeah.
The goal of a synthetic position, as the source puts it, is dressing up like you own the stock when you actually don't.
So you get the same risk and reward, but without buying the shares themselves.
Precisely. You create a profile that functions exactly like owning the underlying stock, but it often requires way less capital upfront.
The source used a Clark Kent analogy for this, which I thought was helpful.
Yeah, it's a good one. When you execute this specific combination of options, the position acts like Superman. It acts like a long stock position.
Yeah.
Even though you're just, Clark Kent, you haven't actually bought the stock. You're just synthetically recreating the profit and loss curve.
Okay, so for anyone listening who isn't deep into options, how do you actually build this thing? What are the parts?
This combination of two specific contracts at the same time. You are long call option and you are short a put option.
Okay.
And by packaging those two together with the same strike price and the same expiration date, you basically cancel out a lot of the weird decay effects of options. What you're left with is a position that moves dollar for dollar with the stock, just like you owned it.
It sounds complex, but I get the function. It behaves like stock, but uses less capital. And that connects right back to what we were saying earlier about strategic investment and leverage.
Exactly. And look at the stock they used for the example trade. It wasn't some crazy volatile meme stock. It was Fast, the Fastenal company.
Right, a huge industrial supply company. Pretty boring, actually.
Boring is good. It's a slow and steady giant. The choice of a solid, less volatile stock shows the discipline that's built right into the strategy itself.
But the trader didn't stop there. They took the basic synthetic position and then they started selling calls against it, which is basically turning it into a long-term cash flow machine, right? The source said they were squeezing out monthly premiums.
Right, which it requires even more discipline and active management.
And here is the moment where the psychological theory gets a real-world test. That synthetic unicorn position, leveraging a steady company and the efficiency of options, went up. A staggering 1611%.
1,611%. And that's not some back-tested number. It represents a real, massive, instantaneous, life-changing amount of money on the table.
This is where we get to what the source calls the million-dollar juice debate.
Yes, because when you're staring at a gain that big, what do? Do you, option one, close the position right now and lock in that huge gain before it disappears?
Which is what every instinct in your body is screaming at you to do.
Screaming, or do, option two, stay disciplined. Do you stick to the original lower risk plan and just keep collecting those monthly premiums until the contract expires?
That decision is it's pure pressure. I mean, if you've ever had a stock jump even 50%, you know that gut reaction, that urge to just hit the sell button. The scarcity mentality would be going into overdrive.
This is the ultimate test for that wealth mindset. The decision is not purely analytical. It's all about those internal concepts we were just talking about. If you give in to fear, if you give in to scarcity, you close the position. You take the huge gain, sure, but you've abandoned your original strategy.
And to hold that position, that requires an unbelievable amount of delayed gratification. You are literally sitting on a 1,600% return while sticking to a plan that's just bringing in these small monthly payments.
That is the definition of discipline.
Yeah.
It determines whether you can stick to your plan or if you let that internal fear and anxiety just take over.
So the synthetic unicorn trade itself, which required discipline to set up and then this immense fortitude to hold. It kind of proves the whole argument about the smart money mindset.
It absolutely does.
The lesson here seems pretty clear. It doesn't matter if you're deciding how to invest $100 or navigating a 11% gain. The psychological test is the same. Your ability to manage that success, to resist panic selling, or to just stay grounded enough to stick to the plan. That's a direct test of your internal discipline.
Right. Wealth is attracted by that mindset, but more importantly, it's sustained by it. The external strategy is only ever as strong as the internal belief system that's guiding your hand. You have to have the psychological strength to stay the course, even when the numbers are just screaming at you to do something else.
So let's bring this all home. We've talked about how financial freedom really starts with defining wealth for yourself, conquering those internal barriers like scarcity, and adopting a growth mindset where money is a tool.
And we've shown how that strong internal framework is what prepares you for success at any level. Whether you're breaking the paycheck-to-paycheck cycle like Sarah,
Or managing a massive, complex gain from something like the synthetic unicorn.
the strategy is just the map. Your mindset is the compass.
In the end, the biggest challenge isn't learning how to execute a complex trade. It's deciding what that gain actually means for your goals and having the mental toughness to stick to your plan even when every part of you is screaming.
And that raises, I think, a really important question for you, for the listener, to think about. We focused a lot on unexpected success today. But traders also face failure. They face painful losses all the time. So the question is, how does your current financial mindset, your relationship with fear, your sense of scarcity or abundance, how does it affect your ability to make rational decisions when faced with unexpected success? Or with equally painful failure? The answer to that question might be the most valuable deep dive you ever take.
We'll leave you with that thought. We hope this gave you a new perspective on that crucial link between psychology and wealth. We'll see you next time.